Welcome back to Part B of Topic 12 lecture. We will now continue with the rest of Learning Objective 3. In particular, we will look at accounting for NFP expenses. So expenses in not-for-profit entities need to be recorded in accordance with accrual basis of accounting. Expenses are recorded as decreases in net assets without donor restrictions, and expenses need to be functionally classified. Program classifications will result from the provision of goods or services that help achieve the major purpose or mission of the NFP. Examples of these would be research, information, or advocacy and public awareness programs. So the expenses pertaining to this will be part of functional expenses. The support activities, on the other hand, assist the NFP in carrying out its mission. So an NFP cannot carry out its mission without funds, and therefore all fundraising expenses will be part of support activities, and so with management and general expenses. What happens when there are joint costs of fundraising? Well, not-for-profit organizations often will conduct activities that will combine a program or administrative activity with fundraising. So in the example I have mentioned earlier, when you're doing a door-to-door knocking campaign and you are, for example, promoting health habits, but at the same time, you are also raising funds for people who would like to donate to the NFP. So there will be what you call a combined program and administrative activity combined with what? With fundraising, right? So FASB guidelines for allocating joint costs of these activities are explicit. They are as follows. The total cost of activities that includes a fundraising appeal should be reported as fundraising costs unless a bona fide program or management and general function has been conducted in conjunction with the appeal for funds. So in my example, it looks like there is a bona fide program being conducted together with the fundraising campaign. So the joint costs of a bona fide program or management and general function should be allocated between the bona fide function and the fundraising using an equitable allocation base is what needs to be determined. Now, there are three criteria that must be met in order to conclude that a bona fide program or management and general function has been conducted in conjunction with the appeal for funds. So what are these three criteria? The criteria for purpose, audience, and content. In terms of purpose, the criteria for purpose is met if the joint activity helps accomplish a program purpose or a management activity. So, what is the purpose of the campaign? If it is to instill healthy habits with the community and the activity accomplish the purpose, then it meets this purpose criteria. The audience criteria is met if the audience was selected primarily for a program or management purpose rather than their ability to make a donation. For example, they have chosen a particular suburb, and that suburb is the one that really needs boosting in terms of health information to develop healthy habits. So the suburb was chosen for door-to-door campaign because of the program purpose. All right, it is just incidental that they also are able to make donation. So they didn't choose the suburb because it's a rich suburb who can afford to give donations. All right, so That's the criteria for audience. The content criteria is met if the joint activity motivates the audience to action in furtherance of the mission or meets the management responsibility. So again, the content has to do with, all right, are you really promoting healthy habits and all that? And how do you do it? Are you just telling them that, all right, we are here collecting money, and by the way, you can read some healthy habits information in this pamphlet? If that is what you're doing, you're more likely fundraising rather than promoting your program. All right, so it needs to be that the joint activity motivates the audience to action in furtherance of the mission of the NFP and in particular of the program itself. Let's look at management and general expenses. Now, management and general expenses include the cost of publicity and public relations activities, informational materials that contain only general information regarding the NFP's program, and the cost of informational materials distributed to potential contributors but not as part of a fund drive. All right, so these will be considered management and general expenses if the information is general, not specific to a fund drive. All right. The costs of budgeting, for example, accounting, legal services, office management, purchasing of supplies, and general publicity, all those are considered management and general expenses. But when you are already giving pamphlets for a particular fund drive, then it's no longer part of management and general expenses. Let's go to accounting for assets. Now, accounting for assets for not-for-profit entities are mostly the same for for-profit entities, but there are a few unique ones. In particular, assets with restrictions on use. So assets that are not available for current operating purposes because the donors have limited their use to a long-term purpose, for example, the capital asset acquisition, will be considered restricted assets. Now, FASB indicates that such assets should be classified separately from the current assets on the face of the statement of financial position, not just as part of the notes to the financial statement. So it has to be disclosed and recognized in the statement of financial position. Let's look now at the investment asset. FASB provides guidance to not-for-profit entities on accounting for investments, debt securities. In terms of the issue of purchase investments, it will be recorded at acquisition price of the debt securities or at fair value for the equity securities. In terms of donated investments, it will be recorded at fair market value on the date of donation. For reporting periods such as the end of fiscal year, the fair market value of those investments will be at that measurement date at the end of the fiscal period. There's no need to categorize the classification, but in terms of realized and unrealized gains or losses, it must be reported on the current period statement of activities. It will obviously affect the appropriate net asset accounts, that is the net assets without donor restrictions or the net assets with donor restrictions. So it is important to be able to calculate the realized as well as the unrealized gains or losses. In terms of the footnotes, the detailed disclosures of these investments need to be provided as the notes to the financial statements. All right. Now, collections is another important asset of certain not-for-profit entities. What are collections? These are defined as the works of art, so paintings, sculpture, and the like, historical treasures or similar assets that are, number one, held for public exhibition, for education or research in furtherance of public service rather than for financial gain. So there will be quite a number of collections in museums, for example, and in certain universities. The collections must be protected or kept unencumbered, cared for, and preserved by the NFP, and it should be subject to an organizational policy that requires the proceeds of the items that are sold to be used to acquire other items for collection. So, collections may be recognized or not recognized as assets, but selective capitalization is not permitted. So you can't say, all right, I will recognize these certain collections but not this one. So you can't be selective. Capitalized collections should be recognized as assets in the period in which they are acquired. Capitalized art or historical treasures need not be depreciated as long as their economic benefit is used up so slowly that their estimated useful lives are extraordinarily long. So this characteristic exists. When do you know that these capitalized art or historical treasures have extraordinarily long estimated useful lives? So, number one, the assets individually have cultural, aesthetic, or historical value that is worth preserving perpetually, and the holder has the technological and financial ability to protect and preserve, essentially the undiminished service potential of the asset, and is doing that. So a lot of the museums, for example, will have their curator, and they will have people who are able to really preserve the works of art in excellent condition. Now, let us move to learning objective 4, and this is where we will explain the accounting for NFP consolidations and combinations. So, a not-for-profit entity can have financial relationships with a for-profit entity, other NFPs, or government units. These relationships may result in the need for sometimes consolidation of interest when reporting on the financial statements. So just like with businesses, NFPs can acquire or merge with other entities. So FASB provides that NFPs can recognize a combination of two or more NFP organizations as either a merger or an acquisition. So what is a merger? A merger occurs when two or more NFPs combine and create a new NFP. So what happens? At the date of the merger, the new NFP will recognize the assets and liabilities of the merging NFP organizations at the amounts reported on the GAAP prepared financial statements of the merging NFPs. So for example, you've got the Helping Hand and the Feeding America merge. Whatever assets and liabilities Helping Hand has and the Feeding America have will be combined together, and they will be known as another or new NFP. For example, they will just be known as America's Help, let's just say. Now, in terms of acquisition, an acquisition occurs when one NFP obtains the control of one or more NFP activities or businesses. So what happens in an acquisition is that the assets and the liabilities of the acquired NFP will initially be recognized in the acquiring NFP's financial statements using the acquisition method. So we won't go into so much detail with this, but basically whatever value of the assets and liabilities will be transferred to the acquiring NFP. Let's now move on to the final learning objective, and this is where we will spend the rest of this lecture on the preparation of journal entries and the financial statements in accordance with GAAP that governs the NFP organization. So in this example, we are using the Community Family Service Agency. The trial balance as of 31st December 2019 is actually provided here, and then we will have illustrative transactions for the year 2020, and then the financial statements will be provided later. Contributions received in 2019 but specified by donors for unrestricted use in 2020 were transferred from the net assets with donor restrictions to the net assets without donor restrictions. So, when you are transferring from donor restricted to non-restricted net asset account, you will be debiting net assets released, expiration of time restrictions with donor restrictions, 5,125, and credit net assets released, expiration of time restriction without donor restriction for the same amount. Now, pledges receivable resulting from 2020 fund drive were recorded. So the pledges of 69,500 were without donor restrictions, and in addition, pledges of 16,500 were donor restricted for a special outreach project to be undertaken in 2020. So the journal entry would be to debit contributions receivable without donor restrictions, 69,500, and credit contributions without donor restrictions for the same amount. For the contributions receivable with donor restrictions, we have 16,500, and the credit would be to contributions with donor restrictions program because it's for a special outreach project for 16,500. All right, let's move on to the next. The collections on accounts receivable amounted to 2,200. Cash for pledges without donor restrictions totaled 68,500. Collections of cash for restricted pledges made this year totaled 16,500, and cash in the amount of 9,200 was collected for pledges given during the building fund drive. We will first enter the first part of the transaction. So we received cash for 68,500 plus 2,200, so that's 70,700. And credit contributions receivable without donor restrictions, 68,500, and accounts receivable was to be credited for 2,200. We will also debit cash for 25,700. This is the total of 16,500 and 9,200, and credit contributions receivable with donor restrictions for 25,700. Now, the organization sponsored a bazaar to raise funds for its operations. So this is a special event. The direct cost is 3,000 paid in cash, and the event yielded a revenue of 8,000 and cash contributions of 2,000. So the Community Family Service Agency, it says here, elects to combine the cash contributions and special event revenue when reporting gross revenue from the bazaar. So we will be debiting here cash of 10,000. That's the total of 8,000 and 2,000 here. And credit special event revenue for 8,000. Also credit contributions without donor restrictions for $2,000. We will also be debiting a special event direct cost of $3,000 and credit cash for the same amount. All right. Now for financial year 2020, the Community Family Service Agency received $317,000 from the United Way. Of the amount received, 13,200 was recorded by the Community Family Service as a fundraising expense paid to the United Way, and the remainder was recorded as a cash contribution without donor restrictions. So the journal entry would be to debit cash as well as fundraising support expenses. The cash to be debited is really the difference between 317,000 and the recorded fundraising expense of 13,200. So that is 303,800. Fundraising support expenses is that 13,200, and the contributions without donor restrictions is the full amount of $317,000. Now, salaries expense for the year totaled $265,000, employee benefits expense $51,000, payroll taxes expense $20,300. And as of year end, 15,100 of these expenses were unpaid. The balance had been paid in cash. We will be recording salaries expense for $265,000 as given, employees benefits expense $51,000, payroll taxes expense $20,300, and we will be crediting cash as well as the accounts payable and accrued expenses. All right, how much of this would be to cash? Well, it says as of year end, 15,100 is unpaid. So the difference between the total of these three figures minus 15,100 will give you 321,200. All right, the next transaction. The expenses incurred for the special outreach project were professional fees, 17,000, supplies 4,500, printing and publications 1,600, and all amounts were paid in cash. So we'll just debit all those expenses, professional fees, supplies expense, printing and publication for the amounts given, and credit cash for 23,100 total. Now we have all these expenses for program services as given here, and it says all expenses were credited to accounts payable and accrued expenses. So we'll just have to enter all of that. Professional fees 43,000, supplies expense 7,800, telephone expenses. So we'll just have to really pretty much copy all that, including the cost of sales to the public 900. So we'll just have to kind of put that one by one. Miscellaneous expense 4,200, and then total up all that and credit accounts payable and accrued expenses for the full amount 186,000. All right. Next, contributions without donor restrictions and revenue were received in cash during 2020 from the following sources. So again, we will be entering that by debiting cash because it says received in cash. All these revenues were received in cash during 2020. So we'll just have to total all of that, and the total of that is 75,650. So debit cash, and the credit will be to all these. These are the revenues. Contributions without donor restrictions is this 15,000. Membership dues is 1,000. Program service fees 55,000. Investment income, and that's without donor restriction, that 2,900. Miscellaneous 1,500. Contributions for the special outreach project with donor restrictions, in that case program, would be 250. Then sales to the public amounted to $1,000 gross for the year, and none of this amount was collected by year end. So sales is a revenue because it arises from exchange transaction, but it's not collected by the end of the year. So we'll debit accounts receivable 1,000 and credit sales to the public. This is part of our revenue 1,000. All right, let's move on to accounts payable and accrued expenses paid in cash. during the year amounted to 182,864. So we'll just debit accounts payable and accrued expenses and credit cash for the same amount. Now, contributions received in cash in 2020 amounted to 20,000, of which 10,000 was specified by donors for use in 2021. So this is restricted by time. 6,000 was restricted for a program and 4,000 was restricted for plan. So we'll debit cash for 20,000, the full amount. We'll credit contributions with donor restrictions time, 10,000. Contributions with donor restrictions program is 6,000, and contributions with donor restrictions plant is 4,000. The next transaction. Interest of 4,540 and 6,500 on the principal of the mortgage were paid. All right, let's look at that item first. So we will be debiting miscellaneous expense for that 4,540 and mortgage payable for the 6,500 payment of the principal for the mortgage. And we'll, of course, credit cash for the total, 11,040. Now, let's keep reading. It says short-term investments that were restricted for plant were sold at par, 5,000. The proceeds were used to purchase equipment. We got cash of 5,000 when we liquidated this short-term investment, and the short-term investment will have to be credited, and this is with donor restrictions plan. Next, then we bought the equipment using this $5,000 that we got. So we debit equipment with donor restrictions 5,000 and we credit the cash for 5,000. All right, because it says there, the donor required the plant assets to be used in the special outreach, and this restriction is satisfied as the assets are used. But for now, the equipment is not being used yet. We just purchased it. Next transaction says interest received in cash on short-term investments restricted for the plant amounted to 1,390, and the interest received in cash on investments of permanent donor restricted endowment funds amounted to 12,780, and this income was not restricted. So we'll debit cash 1,390, that's for the interest, and credit investment income with donor restrictions plant 1,390. For the cash from the endowment fund, we'll debit cash 12,780 and credit investment income without donor restriction because it says it's not restricted here. So that's 12,780. Moving on, the Community Family Service Agency incurred 8,574 in expenses related to contracting for fundraising services. So these expenses were recorded as professional fees expense. So our debit will be professional fees and credit cash for 8,574. Then at the end of the year, a local family donated 100,000 in cash to be held in perpetuity with any investment income or gains and losses, whether realized or unrealized, to be used at the discretion of the management. So here is an endowment fund. We have to debit cash for 100,000 and credit contributions with donor restrictions permanent endowment $100,000. Now, the end of year adjusting entries. The physical count of supplies valued at the lower of cost or market indicated the proper balance sheet value should be 19,100. This is what's left of the supplies. It's a decrease of 3,995 during the year. Prepaid expenses at year end were 3,600, and this represents a decrease of $317. So we will journalize this adjusting entry by debiting supplies expense 3,995 and crediting supplies for 3,995 because there is a decrease in supplies, so we need to credit supplies and will debit supplies expense. Also, debit postage and shipping expense because it says it's chargeable to postage and shipping for 317 and credit prepaid expense $317. Now, an analysis of the investment accounts indicated that the fair value of the long-term investments had decreased. So the long-term investments for endowment had a fair value of $226,000 at the end of the year, and the long-term investments without donor restrictions were valued at $14,000, a decrease of $4,000 and $3,000 respectively. So short-term investments and investments for land, building, and equipment didn't change. Our adjusting journal entry would be unrealized loss on investments with donor restrictions, permanent endowment $4,000, and debit also unrealized loss on investments without donor restrictions $3,000. What we're crediting now is the long-term investments with donor restrictions, permanent endowment fund to reduce its balance by $4,000, and we'll also credit long-term investments without donor restrictions $3,000, also to reduce its balance. The allowance for uncollectible accounts receivable appeared adequate and not excessive, but the allowance for uncollectible pledges not restricted by the donor should be increased by $104. This adjustment relates to current period contributions without donor restrictions. So our journal entry would be to debit provision for uncollectible pledges $104 and credit allowance for uncollectible pledges without donor restrictions $104. So depreciation on buildings and equipment will also be an adjusting entry. So depreciation of buildings and equipment will be debited $4,185. These are given. And credit allowance for depreciation building $1,145, and also credit allowance for depreciation equipment for $3,040. Same is true with journal entry 20B. We will debit net assets released, satisfaction of plant restrictions with donor restrictions for the full amount $4,185, and credit net assets released, satisfaction of plant restrictions without donor restrictions for the same amount $4,185. So what we're doing in entry number 20B is we're transferring from donor restricted net assets to unrestricted net assets. All right. In the end of year reclassification journal entries, what we are doing is we're allocating the expenses to the program, services, and supporting services. So the counseling program expenses, all these figures are given. All right. Counseling program expenses, adoption program expenses, all these expenses will be debited because these are your supporting services as well as program services. All right. And what you will be crediting is the miscellaneous expense of $4,540 and the depreciation expense for buildings and equipment, because what you're doing is you're reducing these expenses but you're allocating it to specific program and supporting services expenses. The natural classification of expenses in entry 7 were allocated to the special outreach project as follows. So we're debiting special outreach project program expenses for the full amount of $23,100, and all these professional fees, supply, printing, and publication that we have debited before will now be credited because it's reclassified to special outreach program expense. Then, except for cost of sales to the public in entry 8, the remaining natural classification of expenses in entries 6, 8, 15, 17B, and 19 were allocated to the various program and support categories in the assumed amounts shown in this journal entry in 23. All right, so we just assume these figures, debiting all these expenses, counseling program, adoption program, and all this and these amounts. And what we're doing is we are crediting all those naturally classified expenses as we recorded earlier in those entries 6, 8, 15, 17B, and 19. So all these expenses will no longer be shown in the adjusted trial balance because it's now being reclassified to the program expenses. Next, the net assets without donor restrictions that were designated by the board for this special outreach project were deemed no longer necessary. So the board authorized the return of the amount of $30,000 to net assets without donor restrictions undesignated. So this is an executive decision made by the board. So based on an analysis of transactions, management determined that $27,400 should be released from restriction as well. This includes the net assets with donor restrictions program on the 2019 trial balance of $3,900 and expenses of $23,500 that were incurred in the current reporting period. So this is very common in NFPs. At the end of the year, the board will have a look and make executive decisions to reclassify the restricted net assets and put it to unrestricted or undesignated for that matter. So the entry would be debit net assets without donor restrictions designated for special outreach project for that $30,000, and credit net assets without donor restrictions undesignated available for operations for that amount. All right. And the next entry would be to debit net assets released, satisfaction of the program restrictions with donor restrictions for that $27,400, and credit net assets released, satisfaction of programs restrictions without donor restrictions for the same amount. All right, then we're nearly there. End of year closing journal entries. So what do we need to close? Firstly, we need to prepare journal entries for the reclassification of net assets released that are closed into appropriate categories of net assets. So that's the first one. 25A does that. What are we reclassifying here? Net assets released that are closed into the appropriate categories of net assets. So all those net assets with donor restrictions time will be debited. Assets released, expiration of time without donor restrictions, the same amount. And we credit net assets released, expiration of time restriction with donor restrictions. Credit also net assets without donor restrictions undesignated, available for operations, and so forth and so on. So you can see from here what we are doing in the first set of journal entries in 25A is reclassifying all the net assets released that are closed into appropriate categories of net assets. In the second set of journal entries, 25B, we are closing support and revenue without donor restrictions are close to net assets without donor restrictions. So what are we debiting here? Contributions without donor restrictions, $403,500, and all the special event revenues, the revenues pertaining to that without donor restrictions. And we're putting it here, net assets without donor restrictions undesignated will be credited. Also, special event direct cost will be credited for the amount given. By the way, all these figures would have been taken from previous journal entries that were made. In 25C, the program and support expenses are close to net assets without donor restrictions. So here we have net assets without donor restrictions undesignated available for operations will be debited, and what we're crediting are all the expenses for those particular programs. All right, so program and support expenses are credited, and we will be debiting net assets without donor restrictions. In D, what we're closing, support restricted for programs, plant, and time are close to net assets with donor restrictions. All right, so we are debiting here the contributions with donor restrictions as to whether it's program, time, as to plant, and any investment income with donor restrictions. And what do we credit? We are crediting it with net assets with donor restrictions, program, plant, time, respectively. All right, so from contributions we transfer it or close it to net assets. What happens with 25E? All the support restricted for permanent endowment is close to net assets with donor restrictions. So to do that, we'll debit contributions with donor restrictions, permanent endowment, the 100,000 that we have received, and credit net assets with donor restrictions, permanent endowment, 100,000, the same amount. And finally, in F, we are closing unrealized losses to the appropriate net asset categories. So we are debiting net assets with donor restrictions, permanent endowment, fund 4,000, net assets without donor restrictions, undesignated, available for operations 3,000. And what do we credit this time? We credit the unrealized loss on investment with donor restrictions for permanent endowment of 4,000 and unrealized loss on investments without donor restrictions for 3,000. So whilst the account titles are quite long, the principles are the same when you are closing the end of year transactions. All right, and finally, once you have done all that, of course, you will have to prepare your adjusted trial balance, and then you can now prepare your financial statements. So we are not going through the nitty-gritty, but here we have the statement of financial position or balance sheet. After all those transactions, adjusting entries and closing entries are made, we have total assets of 541,609 in 2020 and total liabilities and net assets for the same amount. The statement of activities, again, as you can see, it shows 3 columns: the without donor restrictions, the with donor restrictions, and the 2020 total. And you've got your net assets from last period, 2019, and the net assets in the current period, 2020. And here we have the statement of cash flows for the year ended 2020. And this one is using the direct method for cash flow from operating activities. The cash flow from investing activities is provided here, and the cash flows from financing activities here. And you are also shown here the cash at the end of December 2020. And as you can see, the reconciliation of changes in net assets to net cash used for operating activities is provided here. However, as what we have stated earlier, the reconciliation is not mandatory. It's optional if the direct method is used. So this NFP, Community Family Service Agency, is using the direct method, but they have opted to show the reconciliation of the changes in net assets to net cash used for operating activities here. And it looks like the cash used for operating activities, as can be seen here, is negative 53,848. All right. Now you might wonder, why is it that this cash as at December 31st is 128,953, whilst the cash here is 28,953 only. And that's because of the $100,000 in endowment fund. But it is shown here for endowment cash 100,000. All right. So that is it for topic 12. Hopefully you get the idea of how to account for the not-for-profit entity. I'd like to close with this quote from a person who is not known. It says, "The real measure of your wealth is how much you'd be worth if you lost all your money." And that brings us back to our Bible verse in 1 Timothy chapter 6 verse 10, isn't it? "The love of money is the root of all kinds of evil, for which some have strayed from the faith in their greediness and pierced themselves through with many sorrows." So yes, whilst money is useful, it is simply a means to an end. Money can't buy happiness. It can buy you material things. It's all right to use it. It's a means to an end, but that's not an end in itself. What really is important is for us to have the joy in our heart, the fruit of the Spirit: love, joy, peace, patience, kindness, goodness. You know what I mean, right? In Galatians 5 verse 22. All right, so I will leave you with that words of wisdom, and I will see you soon in our class.